It wasn't a glitch in the algorithm, it wasn't a temporary dislocation of supply chains, it wasn't even a speculative bubble driven by retail frenzy. It was the inevitable fracture of a manipulated reality. The number you are seeing is impossible under normal laws of economics. An 80% gap, a price of $71 in the paper markets of the West, a price equivalent to $130 in the physical markets of the East. This divergence is the single most critical signal in the global financial system today. It represents the breaking of the mechanism that has held the monetary order together for 50 years. The pattern is unmistakable, the arithmetic is merciless. When the price of a strategic asset disconnects across geography, it means the underlying currency system is dying. We are witnessing the end of the paper suppression. Of reality, the banks holding the short positions are not just losing money, they are facing an existential annihilation of their balance sheets. History shows us exactly how this plays out. It does not happen in a straight line. It happens in a series of violent spasms, first the denial of the gap, then the restriction of flow. Finally, the chaotic revaluation of everything you own. This is not a theory, this is a forensic audit of a crime, scene that spans 2,000 years. To understand why the banks are trapped and why the price in Japan is the true signal, we must look backward. We must look at three specific moments in history where the official price and the real price went to war. In every single case, the official price collapsed and the real price dictated the future. The pattern is rigid, the outcome is fixed, and the timeline is accelerating. Pause. The first clear iteration of this fracture takes us to the Roman Empire, specifically the crisis of the 3rd century. While many associate Rome's fall with barbarians at the gates, the rot began much earlier in the treasury. The divergence between the official value of the currency and its purchasing power in the real economy created a gap that destroyed the middle class long before the Visigoths arrived. It began with a subtle cheat. In the 1st century, the silver denarius was the reserve currency of the known world. It was 95% pure silver. It was trusted from Britannia to Syria. But the costs of empire, the standing armies, the bureaucracy, the bread and circuses grew faster than the silver mines could produce. The arithmetic was simple and brutal. The state needed more coins than it had metal. Nero was the first to clip the coin, reducing the silver content to roughly 90%. It seemed harmless, an imperceptible tax, but the incentive structure had changed. Once the emperor realized he could print money by diluting the metal, the discipline was gone. By the time of Emperor Aurelian in the late 3rd century, the denarius had been replaced by the antoninianus, a coin that was merely bronze washed in a thin layer of silver. The official decree said this was money. The soldiers and the merchants knew it was trash. This is where the price gap appeared. The state insisted that the coinage held a specific value. They paid their legions in this debased currency. But the merchants, the butchers in the forum, the grain importers in Austria refused to accept the official valuation. Prices in terms of the debased currency exploded. This wasn't just inflation, it was a bifurcation of reality. There was the state price, which existed only in the fantasies of the bureaucrats, and the street price, which reflected the actual scarcity of goods and the worthlessness of the coin. The climax of this absurdity came with Emperor Diocletian in 301 AD, faced with soaring prices that were tearing the social fabric apart. Diocletian issued the edict on maximum prices. This was the ancient equivalent of the paper price suppression we see today on the COMEX. The edict set strict price caps on over 1,000 goods and services. It dictated the price of wheat, the price of olive oil, the wages of a stonemason, and the cost of a pair of boots. The penalty for violating the official price was death. Think about the incentives. Here the state tried to enforce a price that was significantly lower than the market reality. The result was immediate and catastrophic. Goods simply vanished from the official markets. Farmers refused to bring their produce to the cities if they had to sell at a loss. The official economy ground to a halt, but the real economy didn't die. It went underground. A massive black market emerged where goods traded at their true value, often hundreds of % higher than the edict allowed.
The middle class unable to navigate the black market and targeted by tax collectors was wiped out. the lesson from Rome's start. When the state uses force to suppress the price of reality eventually wins, but it burns the society down in the process. Just like the Roman attempt to legislate value, the Spanish Empire in the 16th and the 17th centuries fell into a similar yet distinct trap of price dislocation. The Spanish experience was driven not by the debasement of the coin but by a misunderstanding of what wealth actually was. The Spanish crown believed they had solved the problem of finance forever. They had an endless stream of hard money flowing across the Atlantic, but the laws of economics are universal. You cannot print or dig your way to prosperity without a matching increase in productivity. The Spanish flooded Europe with silver, but they did not increase their domestic production of cloth or grain or ships. The result was the price revolution. This was an international arbitrage gap. Because costs in Spain were so high, Spanish industry was decimated. It was cheaper to import everything than to make it at home. The Spanish textile industry collapsed because it couldn't compete with cheaper foreign goods. The wealth of the silver mines hollowed out the productive capacity of the nation. The crown, despite owning the mines, was constantly broke. Philip II, the most powerful man in the world, defaulted on his debts not once but 4 times in 1557, 1560, 1575 and 1596. They had bet on the official solvency of the empire, ignoring the structural rot beneath the human cost was visible in the streets of Seville and Madrid. While the nobility draped themselves in imported silks, the off-rich Spaniards saw their purchasing power evaporate. The influx of money had concentrated wealth at the top while driving up the cost of living for everyone else. The gap here was between the perception of Spain as the wealthy master of the world and the reality of a hollowed-out economy that produced nothing but inflation. When the silver flow eventually slowed, there was no more economy left to fall back on. The empire crumbled, leaving behind a legacy of beautiful cathedrals and a destitute population. The market had corrected the imbalance, and the correction was a century of decline. Just like the Spanish illusion of endless liquidity, the Weimar Republic in early 20th century Germany provides the most terrifying example of a short squeeze on a national currency. This is the most precise parallel to the bend short dynamic we see today. In 1914, the German mark was a gold-backed currency, respected and stable. By 1923 it was confetti. But the transition was instantaneous. It was a process of widening gaps between the paper reality and the physical reality. After World War II, Germany was saddled with massive reparations payments denominated in gold marks or foreign currency. The German state could not pay. Their industrial base was shattered and their gold reserves were depleted. The solution chosen by the Reichsbank, led by Rudolf Heffenstein, was to print paper marks to buy foreign currency to pay the debts and to subsidize the striking workers in the occupied Ruhr. This was the gap. For a brief period, foreigners flocked to Berlin because everything was incredibly cheap. If you brought dollars or pounds, you could buy a block of flats for the price of a nice lunch in London. As the printing accelerated, the German population realized that the paper money was a claim on nothing. The short squeeze began. And a short squeeze occurs when everyone tries to exit a position at the same time, but there is no more liquidity. A worker paid in the morning would rush to the bakery to buy bread, because by the afternoon the price would have doubled. The official exchange rate published by the government became a joke, lagging hours or days behind the street rate. The only survivors were those who held physical assets, land, machinery, gold, and the foreign currency. The gap between the paper mark and the physical reality closed with a reset that wiped out the middle class and paved the way for political extremism. In Rome it was the copper-washed coin. Stage 2 is the divergence. The supply of the real asset tightens but the paper price remains low.
and the exchanges admit the disparity and slowly raise margin requirements to force speculators out, allowing the price to drift higher while managing the bank losses via backroom bailouts. This is unlikely given the speed of the current drain. The second is chaotic collapse. This is the failure to deliver. A major bullion bank declares it cannot meet its obligations. The COMEX declares force majeure, settling contracts in cash at the low paper price. Holders of paper get pennies on the dollar. Holders of physical see the value skyrocket instantly. This mirrors the closing of the gold window in 1971, but much more violent. The third is reset and restructure. A new pricing mechanism emerges, likely led by the Shanghai Gold Exchange or a BRICS-aligned commodity basket, where price discovery is based on physical delivery, not paper speculation. This permanently shifts financial power from the West to the East. In 1933, the U.S. government confiscated gold to reset the system. In 1971, they defaulted on the gold peg. In 2024, the market is forcing the reset. The only variable is timing and pain. If you are holding the paper contract, you are the creditor to a bankrupt entity. If you are holding the physical asset, you are your own central bank. Subscribe to this channel.